Greetings, everybody. My name is Greg Sweeney. Welcome to the mid-year 2022 update on the economy and the markets. The economy year to date is going through a landscape change. The Federal Reserve is raising interest rates on the short end of the yield curve, also curtailing their quantitative easing and potentially selling assets from their balance sheet. Now, this might not mean very much to you, but it does suggest that interest rates are going higher. And the reason interest rates are going higher is to combat probably the number one concern in the marketplace right now, which is inflation. Here's a chart on inflation. It's very busy, very colorful, but it probably lends credibility to exactly what you've been seeing in your own household budget. Prices have been going up for about a year and a half now, starting back in February 2021. Initially, it was showing more of its price sensitivity in the area of used automobiles and energy. But as you see all the different colors on that line, as it moves to the right, inflation is spreading to more and more areas of the market. So with interest rates going higher, the stock market is looking to adjust to this new dynamic. It's having a hard time determining whether it's going to be beneficial and stocks would continue to go higher, or if it's going to be a challenge and stocks go lower. Obviously, year to date, we know that stocks have been down about 20%, a challenging year for certain, but it's part of the overall process. A big part of the economy in the United States is the consumer, and consumer sentiment is at a 2-decade low. As you can see on this chart, this gives us some idea of what the consumer's mentality is. Now, this is in contrast to what we see in mainstream media. A lot of economists will come on and tell us the consumer is in good shape. They're prepared to continue their spending. We're seeing something quite a bit different, not only in consumer sentiment being at the 2-decade lows, but also we're starting to see some pressure on the consumer show up in slowing payments for things like cell phone bills, credit card debt, automobiles, and consumer borrowing. We're starting to see some delinquency rates increase there. The confusion in the market, though, probably comes from indicators like this. This is a leading economic indicator. It includes things like income, manufacturers, orders, stock market, job market, bond market. And this has not captured what we're seeing on a more real-time basis. And leading economic indicators still say everything's just great. So there's part of the dispersion we see between potentially good characteristics for the economy and maybe challenging characteristics for the economy. In picture form, this is what the sell-off looks like this year. The very far right-hand side shows about 20% decline in the S&P 500 through the end of June 2022. Again, that's because of some of the things that are happening as the dynamics of the market change right now. Earnings are, corporate earnings are in question, declining margins, the prospect for multiples declining are all part of this concern. And it's important to remember as an investor to stay focused on the long-term horizon. You can see that these market sell-offs are not unusual. You can see history all the way back for the S&P 500. If you go all the way back to the Great Depression, you can see that. Sorry about that. You can see that the negative marketing went for as long as 4 years back in the 1930s. That is not a normal situation. You can see a more recent one, which would be the tech stock bubble. It lasted for 3 years. You can see the Great Recession in 2008 and 9. That was a one-time, very large sell-off, over about a year's point in time. You can see the late 2018 sell down, and then the most recent one at 20%. But don't lose sight of how the market is done on a long-term basis, going up on the other side. Successful investors will stay focused on the long term and stay invested. Timing is very difficult. One way to look at this is to look at the market like a bar of soap. The more you handle it, the smaller it gets. That may seem counterintuitive when you turn on the TV and you see all these people telling you to sell one thing and buy another to make it, to make your portfolio better. But the reality of it is, you pick a long-term allocation that's consistent with your long-term goals, and you leave it in place. Case in point, Here's an example of missing just the 10 best days in the S&P 500. So over a 20-year time period, $10,000 invested at the beginning of 2002 would be worth $61,000 today. If you missed the 10 best days, just the 10 best days over a 20-year period, the portfolio is worth less than half of what it would have been. And as the chart goes on, you can see what happens if you miss the 20 best days, 30 best days, 40 best days. Now, some people ask me, well, what about the missing the 10 worst days? Obviously, it would be the inversion of this chart, right? It would make your returns look a lot better. But just like it's very difficult, let's just be honest with ourselves and say impossible to determine when the 10 best days are and be in the market. It's also impossible to know when the 10 worst days are and be out of the market. So market timing is not a successful investment strategy. Year to date, not all sectors of the stock market have been created equal. U.S. stock market, as I mentioned, is down about 20% over on a year-to-date basis. But if we look at one-year numbers, they're off about almost 11%. Keep in mind, though, over long periods of time, three-year numbers are still up 10.6%. Remember that the average return on the stock market is about 9.5%. So the market is still consistent with its long-term average. Interestingly enough, if we go over to the far right-hand side of this graph, we see that growth stocks, now these are usually the darlings of the market. The growth stocks are off quite a bit more than the market in general. They're still up 12.5% over a three-year basis, down almost 19% on a one-year basis. But look at value stocks. Value stocks are usually ignored by the market because they're not as exciting and sexy as growth stocks are. Value strategies have been favored this year, off 13% year to date, almost 7% on a year-over-year basis. But look at the three-year number, not as attractive as the overall market or the growth sector. So you can see that the market rotates between particular styles. Value is the winner year to date and over the last year. But again, this is not something that you would be trying to shift between in terms of your overall portfolio allocation. Plus, within the asset allocations you have, there's usually a mixture of value and growth. So from a representative standpoint, the broad stock market returns are probably the best representation of how the market is performing this year. Fixed income is usually a diversifier in a portfolio. The idea of a fixed income allocation is it's supposed to act as a shock absorber and absorb some of the sell-off in the stock market. It has done that this year, but it hasn't done a very good job because this has been a very difficult year for fixed income as well. So stock market year to date, as of the end of June, represented by the S&P 500, is off 20%. The bond market, represented by the aggregate bond index, is off about 10%. These are numbers, according to Deutsche Bank research, that we have not seen since 1788. So, 240 years ago is the last time we saw a challenging investment market like the one we've seen in the first 6 months of this year. So if you hear people say, I've never seen this before, that's the reason why they've never seen it before. We've never seen it before either. You'd have to be a very, very old person to have seen this in the past, according to that Deutsche Bank research. So rising interest rates erodes the value of fixed income securities. You can see that the 10-year treasury on this graph, I know it's small, I apologize for that, but the 10-year treasury hit about 0.5% in the middle of 2020. And since that time, the interest rate has climbed to about 3%. Rising rates is very harmful on a market value basis to fixed income securities. Even though the interest rate's going up, the market value is going down. And that's what we're seeing in the fixed income market this year, is that rapid decline in market value as interest rates have drifted higher. Now, the good news here, if there is any good news, is we suspect that most of this pain is behind us at this point, and we will not see fixed income perform the same way in the last half of the year. We expect the performance to be much more muted. It might not go up much, but we don't expect it to go down very much either. One of the questions we're asked is, where is the market going? Well, we never know for sure where the market is going, but we know that in the last 20 years, there have been several sources of different dynamics in the market. you look at this graph starting in 2000, in the wake of the tech stock bubble, you see the equity market selling off between 2000 and 2003. That was about a 45% sell-off, rallying all the way back up to basically where it was at its peak during a tech stock bubble in 2007 before we hit the financial crisis, and it sold all the way back down, actually lower than where it was at its lows in 2003. We didn't make it back up to the high levels and sustained levels above the point where the tech stock bubble occurred until the middle of 2013, at which point the equity market continued to rally all the way into the pandemic. We see the sell-off at the start of the pandemic, and then a very rapid shift in the direction of the overall progress of the S&P 500 since the middle of 2020 and going higher, reaching a peak that really represented the high of the market, which was around the beginning of the year 2022. We've since seen a sell-off, and here we are today with the question, where does the market go from here? Well, it really depends on a number of things, including corporate earnings, whether margins are continuing to expand or not, the attitude of the investor, multiples, and things like that. So here's our best guess. Our best guess is that earnings can continue to come in fairly reasonable in relation to expectations moving forward. That means the S&P 500 about now is probably fairly priced. You can see we're expecting earnings to be about $240 a share for the S&P 500, and we expect the multiples to be about 16 times earnings, which suggests the market today is fairly priced. However, let's just say earnings are $230 and multiples go down to 15. That means the equity market probably sells off about 9% from where it is today. We don't know for sure. Part of this has to do with investor attitudes as well. But for our long-term investor, again, stay invested. Successful investors ignore the short-term volatility and focus on their long-term goals. I'm going to revisit a slide we talked about earlier with one more line added. The green line on this chart shows us the long-term average rate of return on the S&P 500 being about 9.5%. I mentioned earlier that the 3-year average return on the S&P 500 is still above that line. The 5-year and the 10-year also represents a very attractive return to the long-term average. Again, another testimony to remaining invested in this market environment. As we look forward, there's some things to continue to watch. Of course, inflation, we expect to continue to be a work in progress. We don't expect inflation to stay at these levels for long periods of time. There are 3 very strong forces suggesting that inflation comes back down. One of them is demographics, another is globalization, and another is technology. You know, will we see it get back down to 2% again? Maybe not. 3%, yeah. More near term. When I say near term, I think that's where it's probably going to drift to over the next 12 to 18 months. Are we at a peak right now? Not quite sure. I think I'd rather use the word plateau, where we remain at an elevated level above probably 6% for the rest of the year until we start to migrate back down to more reasonable levels of inflation. Employment continues to be strong, but we're starting to see corporations announce layoffs, curtail hiring plans. So the increasing Fed interest rate environment is having its effect on employment. Of course, keep in mind the Fed has 2 goals: 1, reasonable pricing, and 2, maximum employment. So it's always a push-pull between inflation and keeping employment as strong as they possibly can. Monetary policy, we expect the Fed to hold their interest rates high enough to break the inflationary cycle before they respond with declining interest rates again. How long will that take? Hard to know, but the Fed probably remains in a constrained, by constrained we mean a higher interest rate environment for the rest of the year. Next year, into probably the second quarter is where the Fed might look at maybe going to a more neutral policy and taking some of their interest rate hikes off the table. None of this is immediate. Interest rate hikes take about 9 to 12 months to work their way into the economy, and so don't look for immediate economic responses one way or another. GDP. One of the main questions right now is, will we go into a recessionary period? The market kind of looks at the recession as 2 quarters of declining GDP. We saw the first quarter of declining GDP from January to March in 2022 this year. Will we get another one? The Atlanta Fed suggests that we will. The National Bureau of Economic Research, NBER, is the one who is the agency that ultimately declares whether we were in a recession or not. And they don't declare that until after the fact. I think the point I want to make here is we think a recession is more of a headline issue than it is an actual economic problem. And the reason we say this is the rapid growth we saw in GDP and what we're coming off of now on gross domestic product is the stimulus money, not only from our own government and Federal Reserve, but from central banks and governments around the world. And the decline in GDP is just going to get us to where we would have been under a more normal economic cycle without the pandemic and without the stimulus packages that occurred, like I said, from governments and central banks around the world. So more of a headline than a real problem in terms of what we see on the horizon if in fact we do go into a recessionary period. So we're not looking for a big washout just because we go into what will formally be declared as a recession. Finally, supply sourcing will probably continue to be constrained, but that will slowly work its way through the system as well. One last slide. We do these outlooks quarterly, but for those of you who are looking for more recent updates, you might want to go to bellbank/news. We do a monthly outlook in that section. We try to keep it to just 1 page long, so people will actually read it, right? And it's hard to keep someone's attention on something like this that's hard to understand. But we get some pretty good feedback from these. So if you want to maintain, keep updated in between these recorded calls, that's one way you can do it. Thank you everyone for taking the time to watch this, and have a wonderful day.